All right. Well, good afternoon. Thank you, everyone, for
Thanks.
joining us. Today, we're going to be taking some time to cover a lot of the high points, the big talking points that were in the tax law that was signed, or the tax bill that was signed into law on July 4th, called the One Big Beautiful Bill Act. We are going to ask that if you would just please keep your microphones on mute until the end of the presentation, or at least whenever we'll have some break times in between to address some questions and that will help us just be able to move forward without like echoes and things like that. So with all of that out of the way, I'm going to hand it over to Mike to start us off.
Thank you, Charlie. Good to see everyone today. Thank you for joining us on this beautiful August day here in Atlanta, Georgia. It's really good to see everyone and talk about this fun and wonderful tax topic. So thank you guys for joining us today. Like Charlie mentioned, we're going to go over some highlights that we've pulled out of the One Big Beautiful Bill Act. And of course, the bill is so big and beautiful that we don't have time to cover all of it in 25 minutes. But we're going to hit some highlights that we think could be useful for most of you in your financial and tax planning. And of course, we're going to handle any questions here along the way as we go. So, a couple of things included in the slide deck, we'll have our biographies and whatnot. But want to highlight one item y'all may not know about Charlie is he holds the enrolled agent designation. So, he is very well versed in taxes and tax planning. And Charlie, kudos to Charlie, has put a good amount of the research and work into preparation of our material today. So very grateful for that and the contribution he brings to the team. Next up, for those of you who like to put a face with a name, just let you know who you're working with here at Tarrant Financial. Obviously, Charlie and myself, Carrie and Liz are working with us virtually. And then we have a couple of others with IFG that you hear from time to time as well, Greg and Carmen. So that's the makeup of our team. And just for those of you who may not know who we are, and you're a guest here today, Tarrant Financial Advisors. We are an independent financial planning and investment advisory firm headquartered here in the Atlanta metropolitan area, but working with clients literally all over the state and all over the country. So we're very happy to help people align their money with their goals, avoid blind spots, define their 3-year vision, and really plan with purpose so they can help their finances fuel what they want to do best with their friends and family, with their dreams. So that's what we're all about. Today's agenda, we're going to cover really 5 key areas of the bill. We're going to look at some changes related to individuals and families, philanthropy and education, estates and gifts, and some new savings vehicles that might be useful to some of you, and wrapping up with some small business items. And we do have some bonus material at the end if we have a little bit of extra time. So with that, we're going to give you a couple of disclaimers here. Obviously, we are not CPA, so we can't give specific tax advice per se, but we can definitely give you recommendations, or I should say, give you suggestions to incorporate into your financial planning. Some of these changes go into effect this year, others are 2026 and even beyond. So what we're here to do today is report so you can decide how best to implement these in your financial planning. Of course, if you have questions about how it impacts your planning, feel free to reach out to us. We're pretty well versed in the law, and we can help you figure out how to apply that to your situation. And then we'd always recommend wrapping that up with a more formal projection and review with your CPA or tax advisor. So with that, Charlie's going to talk about some key enhancements and extensions of the 2017 TC&J Act, and we'll go from there. Charlie, take it away.
Thank you very much. Just to begin, before we really dive into it, I want to talk just a moment about the the fact that there were a lot of things that were said about the law before it became a law. So we had, before it was even drafted, we had the things that the president wanted to see in the bill, and then we had the House version of the bill, and then we had the Senate version of the bill, and then the version that was passed and then signed into law. So I just wanted to mention that just to be careful when you're online looking up things related to what was in the law, and even if you're using like Chat GPT or another AI to give you a summary, there is a little bit of confusion with some of the measures that were passed that where you could get inaccurate or outdated information. It's real easy to do. So Mike and I found this whenever we were researching for all of the content here. So we just wanted to put that out there to begin with, just to make sure, just be careful and verify check with us or your CPA if you have any questions, if you're uncertain about whether something was actually in the final law that was signed or if it was something that was just proposed. All right, well, to begin, one of the biggest things that happened was we were facing what they call a sunset at the end of this year, where a lot of the individual tax rates were going to go up because the Tax Cuts and Job Act made a lot of tax cuts, but they weren't permanent. They were set to expire at the end of this year. The big beautiful bill act made a lot of those permanent, and we just remind everyone though that permanent doesn't really mean permanent. They said there's nothing more permanent than a temporary government measure, and there's nothing more temporary than a permanent government measure. But anyway, the individual rates are permanent, which simply means they would have to pass a new law in Congress and be signed by president in order to change the tax rates and the tax brackets, other than just their simple adjustments for inflation. So that's what we're looking at going forward. So this was, in general, a positive thing for most taxpayers, or cuts that we received that were extended. And one of the things was the standard deduction, where we moved away from your personal exemption and moved more into a higher standard deduction, which kind of took the place of it, simplified things a little bit. And those are the numbers that you see here on the screen. They're going to be indexed for inflation going forward. So we won't have any situations in the future where we kind of get stuck behind and then it suddenly takes a big jump. It'll just adjust a little bit each and every year, unless we happen to have a year without inflation, in which it would stay static. The child tax credit is a big deal for anyone who has kids in the household. Quick reminder that it does only cover or apply to kids that are under age 17. You would logically think it would apply to anyone under 18, but it actually stops the year that the child turns 17 and then gets replaced with the $500 other dependents tax credit at age 17, starting at age 17 and forward, as long as they are still able to qualify as a dependent. So this would be include if they're in college and you're mostly supporting them while they're in college, they still qualify as a dependent, but they would not get the what used to be a $2,000 child tax credit. Now it's been increased to 2,200. It would be now dropped down to 500. They've also added a deduction for seniors. So really, this kind of effectively makes it's an above the line deduction. It kind of makes it more like an increase to the standard deduction. But if you are over age 65 during the tax year, that applies, you'll get an additional $6,000 per person. So if you and your spouse are both over 65, it's going to give you a $12,000 deduction. But it's not a credit, it's just a deduction off of the income. And they do phase this out starting for a married couple at $150,000 of gross income. So just watch that. Something to be aware of. It's kind of there was some talk about them eliminating the tax on Social Security. That did not make it into the final bill, but they kind of gave us this 6,000 per person deduction as a compromise. I wouldn't say a substitute, just a compromise of that. However, it's only available currently for the tax years 25 through 28. So only for the 4 years of the Trump presidency. After that, it will automatically disappear unless there's more just legislation later to make it permanent. Real quickly on itemized deductions, that's something that phases out at a certain income level. And what they did is they replaced the way it phased out with a new formula. And we won't go into detail how all that works. But long story short, a lot of if you're in the highest tax bracket, you're only going to get a deduction that really that it's going to be capped and make it effectively like you're at a 35% bracket. For a lot of taxpayers, it actually results in a reduction of tax. So it's not necessarily a bad thing. It's just a simpler method and a slightly more beneficial method to calculate it. And then another itemized deduction, your state and local tax deduction cap, that was capped starting beginning in January 2018. It was capped at $10,000. They're now raising that cap to $40,000 if you are a household that has less than 500,000 of gross income. And so what that is whenever you pay state income tax, or some places there's local income tax, and as well as property taxes. The sum of all this, you can only deduct up to $10,000. So if you are in a high tax state, or if you have more than one property, like a vacation home or something like that, that's not rented, you're gonna be able to deduct the interest up to a higher threshold than before. However, it does revert back to $10,000 starting in 2030, unless that's extended by future legislation. And then a quick note on the $500,000 limit. That's where a phase out begins. So if your income is over $500,000, the cap begins to come down, and then it will eventually get to 10,000 the more when you have a sufficient amount of income. So just doesn't mean it's gone completely. Just the worst case is you're still at 10,000 like you were the year before. And then they did simplify things by limiting the moving expense deduction, which was capped at pretty low numbers, so it wasn't beneficial to a lot of people anyway. And I know a lot of the things we discussed were temporary, but here are a few more things that are in the law only temporarily. And starting with a no tax on tips. We got no in quotation marks there because it's not really no tax. It's kind of the language that's been spread around as people are saying there's no tax on tips. There is a $25,000 deduction. So your first 25,000 of tips is going to be tax free as long as you're under the income limit there, which is 150,000 single, 300,000 joint. After that 25,000 is eclipsed, then you begin to be taxed as normal on those tips. So if you know anyone who's in the service industry, food service, or drives for Lyft, Uber, something like that, where tips are a big part of the income, you could see them by the end of the year, if they're full time doing that, going over that limit and having part of their income tax. So you just want to remind them, hey, don't completely eliminate your tax withholding because you may still owe something at the end of the year. And then it's a very similar story for overtime. They also say there's no tax on overtime. It's a deduction of 12,500, so it's half that of what the tips deduction was. So if you're joined, it's a $25,000 deduction of qualified overtime pay. So that is, again, overtime is only if you are an hourly employee. So if you're paid on salary and you work more than 40 hours, you don't get to deduct anything. It's literally if you're just an hourly employee and you clock more than the overtime limit number of hours, then you'll begin to be able to deduct that income. It is also phased out of the same income limits as the tips. One that's been of particular interest to a lot of people is the auto loan interest deduction. So there's a lot said about this before it ended up in the final bill. The version that we got is really not a bad deduction, but it might end up being difficult for most people to check all the boxes to qualify. So first off, the loan has to be originated between 2025 and 2028. So if you bought a car last year, it doesn't count. And if you bought after the end of 2028, it doesn't count, at least currently. It has to be a new vehicle, so used vehicles do not apply. And it has to have its final assembly in the US. So that's important because it doesn't have to be a US owned company. So it can be, for example, a Kia that was manufactured in the US could qualify. But as far as I understand, there are some companies that manufacture and do their final assembly of some models in the US, and some of their models are overseas. So you'd want to check with the dealership to make sure that you confirm that this particular car that you're looking at would have its final assembly in the US and so would qualify. Now, is the IRS going to be going around asking people to defend their interest deduction by showing how, where their car was manufactured? That's up for discussion, whether they have the resources to do something like that or care enough to do something like that. But at least that is what the requirements are. And then last but not least, this starts to phase out at $100,000 of AGI if you're single or 200,000 if you're married. So that can be a limiting factor for a lot of people who are looking to buy a new car in the next few years. All right, so next we're going to cover philanthropy and education. I will hand it back over to Mike.
Awesome. Thank you, Charlie. Before I delve into that, that was a lot of material for that section. Does anyone have any questions they'd like to ask briefly on that particular section that Charlie just covered? If so, just unmute your mic and jump right in. We're happy to answer. All right, all good out there. Very good. All right, well, philanthropy and education, a subject near and dear to my heart. We really try hard to build charitable planning into our financial planning for clients, and we've seen a major uptick in interest in that in the last several years, which is really pretty cool because it makes the giver joyful, right? But it also blesses the recipients. So we really love to try to find ways to help people maximize their charitable giving and sharing of their resources. So first up with philanthropy and education, the charitable contributions. Just so you know, there is a what Charlie mentioned an above the line deduction for charitable gifts. That just basically means you don't have to itemize to get this deduction. It's on the first or second page. I think on the first page of the 1040. But basically, you can deduct $1,000 of charitable, cash charitable contributions for single filers, 2,000 for married filing joint, without having to itemize, and that can show up right there on the tax return. Next up on that is something that's probably going to be a little more obscure. This is one to keep in your back pocket for 2027. So for those of you that might have heard of like a state sponsored scholarship program, like here in Georgia, we have the Georgia Gold Scholarship where you can redirect some of your Georgia tax dollars into a scholarship fund and designate it for a specific private school. Some of these plans are now going to be eligible for a federal dollar for dollar tax credit of those contributions. You see the dollar figures there. It's up to $1,700 per individual taxpayer. Caveats are, it has to, your state has to opt into that program for it to qualify for you. And then it has to be a state approved, fairly recognized nonprofit that distributes the scholarships to the eligible children. So what we expect is we're hopeful that in Georgia, at least, that the legislature will vote to qualify the Georgia Gold Scholarship for this deduction or for this credit. But just stay tuned on that because that can maximize your gift there. Next up, we have changes on the student loan repayment. There's a good bit of material here. So for those of you that have college age students or grandchildren, this might be of interest to you. But essentially, a lot of the deferred interest is going to go away. A good bit of the loan forgiveness is going to go away. Standard repayment is going to really be the norm at this point for most of the loans. So we'll include this in the slide deck for you when we send that out. Then over on the next slide, we've got even more information about this. So there's some new limits on unsubsidized student loans. So you can see there's some qualifications there now for an annual limit at $20,500. There's a lifetime borrowing cap in there now. And there's also an annual limit for professional students in certain areas like medicine, pharmacy, dentistry, law, etc. So there's some caps on these things. And then last but not least in this item, plus loans for parents who are borrowing for their students are now going to be capped at $20,000 per year, $65,000 total per student, and graduate plus loans have been eliminated. So there definitely were a lot of changes there. It sounds kind of complicated. A lot of it was streamlined, and some eligibility has been taken away, but hopefully not too many students are having to borrow. One item just kind of circling back here to Charlie's comments about the standard deduction being made permanent and now it's higher. That also has the impact of really solidifying a strategy that a lot of our clients use, wherein they're charitable givers, but maybe not enough to get them above the standard limit when they itemize their deductions. So a lot of times clients will stack their contributions every other year. In other words, they may give lower in one year and give a lot more in the second year to get them above the standard deduction, which multiplies the tax deduction at a higher tax rate for most people who do that. So that's now going to be a pretty permanent strategy to consider. So if you have a regular budget annually, for a church or a charity, you could consider stacking those into every other year so you get the tax benefit of that. Downside is the charity loses the money for a year until you give it twice in the second year there. Another strategy that's really probably going to be helpful for a lot of clients, it's been very popular, and this is now probably going to be something permanently considered till this tax law changes, would be the use of a donor advised fund. So really, it works really well in a year where you have a large taxable event, like a one-time sale of a business or a large capital gain or something like that. You can make a charitable donation to a donor advised fund, receive the contribution deduction upfront, and then you distribute funds from the donor advised fund over whatever time frame you choose, can even be the rest of your life. So that's a nice way to take advantage of a deduction up front and have control over disbursements. Any questions on philanthropy and education and the changes there? Everybody's absorbing this pretty well so far. Very good. If you have any questions, just unmute your mic and jump in there. Um, Next up, we'll talk about a major change in the estate tax threshold. So you may or may not have been aware that the estate tax threshold was set to sunset at the end of this year, which meant that it was going to go from roughly $14.5 million per person and be cut back in half to where it was 10 years ago, still indexed for inflation. But the higher limits have been made permanent and the sunsetting is going to go away. You'll see we have permanent in quotes, like Charlie mentioned. It's as permanent until there's a new law later. So right now, this is the lay of the land we get to work within, and it's pretty powerful. So the exemption's been made permanent at $15 million per person, $30 million for married couples. The portability feature remained, which just means that if there's an unused portion from the first spouse who passes away, the unused portion ports over to the second spouse. So that way, the married couple receives the full $30 million estate tax exemption. Now, the way this works is what this means any amount of your estate under these thresholds is not subject to the estate tax. The amount over the threshold would be subject to the estate tax. So if you have a very valuable business or family real estate or some stock options or warrants or whatnot that qualify you at these numbers, we'd want to talk about estate tax reduction strategies. And then last but not least, the annual gift exclusion. This is very popular with a lot of our clients who like to transfer some of their wealth, down to the next generation or grandchildren. This was not really addressed in the tax law, so we just wanted to confirm with everyone that it remained the same. It's $19,000 per year per donor, per person, per recipient. So what that just means is, if you have a non-spouse you want to gift to, like a son, daughter, grandchild, $19,000 can be given to them without having to file a gift, without having to pay a gift tax. You do file a form to note that, but it keeps it tax free. Then, of course, if you're a married couple, you can double that to $38,000. So that's still there. It's still a very useful technique. I just wanted to make everybody aware of that. Questions on estates and gifting? Everybody good on that? All right, very good. Back to Charlie for some miscellaneous tax deductions and wrapping up with business issues.
All right, thank you very much. If you've been following any of the kind of the drama around Elon Musk and Donald Trump earlier this year, they kind of had a little disagreement about the clean energy credits. So at least that was part of it anyway. What ended up happening in the bill was the clean energy credits were phased out or are going to be phased out at the end of this year. Included in that is the electric vehicle credit, so that would affect not just Tesla, but a lot of other car companies that are manufacturing electric vehicles. That currently helps keep the price down effectively because if you buy a new vehicle, you can get a tax credit to partially offset the cost. That is going away here at the end of the year. So if you are thinking of buying a vehicle that would qualify, then it could be a good idea to maybe move forward with that. Otherwise, the credit will be not available. And then likewise, at the end of the year, the energy efficient home improvement credit, that's been around for a while. That's for things like more efficient windows and appliances in the home that can reduce the energy consumption of the home. There was a little bit of a tax credit that was available for certain items that qualified. That is also going away at the end of the year. And then speaking of vehicles, one of the changes to savings vehicles was the addition of the new Trump account. There was a lot speculated about this, and I'd say out of everything that we're covering today, this was probably the topic where there's the most confusion about what these actually are and what they do. And we really kind of ran into a red flag whenever we were noticing that when you're just trying to research what's in this thing, you get a lot of conflicting information from one site to the next. They say distributions from these accounts are taxed one way, another site says it's taxed a different way. So we're going to walk through what we found. We ended up going directly to the tax code from the actual language of the bill that was passed, and doing some analysis on that to see actually what it says and what it doesn't say, and then matching that up with some other online sources that had the same information. So real quick, the What a Trump account is, it's an account that's meant to be for a child. It can be open for any child that's under the age of 8. But they have, so if you want to get there's an incentive that if you want to get an incentivized contribution, the government will actually deposit $1,000 into the account for any child that was born from January of this year through the end of 2028. Other than that, families can still make after-tax contributions of up to 5,000 per year. And then your employer can even make a contribution on the employee's behalf of a pre-tax contribution up to 2,500 per year, and that 2,500 does not count towards the 5,000 limit. So you could effectively end up with a contribution of 7,500 total between the parents or the grandparents and the employers. The contributions have to be invested in what they call a qualified index fund. So they've got some stipulations there for what it is. You can't just, they won't let you invest in just anything. They want to make sure that you're investing in a fund that's in US companies, has a low cost, and is index based. So if you think about like your typical S&P 500 index fund, that's really what they're going for. Although there'll be more indexes available to invest in, but that one's likely to be the most common and most popular. So then we get into kind of what does it look like after money's in this account? It grows for a while, and I'll be honest, I'm still kind of scratching my head over some of the decisions that were made, and I think we're going to see a lot of changes between now and when these actually go into effect. So the first thing is there won't be any contributions to any of these accounts allowed until 12 months after the passage of the law. So that means starting July 4th of next year will be the first point at which we'll be able to make contributions to any of these accounts. There will be no withdrawals permitted before the child turns 18. So that's kind of different from what we see in a lot of savings vehicles where maybe you get penalized if you take money out. They're saying right now not going to permit withdrawals before age 18. And then the withdrawals after age 18 will follow the IRA rules, including ordinary income tax and a 10% premature withdrawal penalty if taken before age 59 and a half. The way to escape that 10% withdrawal penalty is via a qualified withdrawal. And again, still sticking with what's the usual IRA rules, is that you can take out the money to use it for higher education expenses like tuition. You can take it out to make a first time home buyer purchase. They do limit at $10,000. That's the same as the IRAs. And then there's been a lot of talk about this being used for for business startup expenses. We didn't find that actually in the law as it was written, but there is a lot of information online about it. So we just put this in here and said potentially. Again, I think my impression is where this part of the law ended up was not really what was intended. And I think there's going to be some changes retroactively whenever and then that may be the reason why it's delayed until July of next year, is to give some time for the IRS to give clarification and potentially Congress to make some changes to how these actually work. And then finally, the account terminates when the child reaches age 31, and then it's at that point it's taxed as if it were distributed. So what does all this mean? How does this look? Well, whenever I first heard about these types of accounts, I kind of assumed it was going to be like a Roth IRA, where you'd be able to put money in after tax and it would grow, and if you used it for a qualified expense, then it would be able to be withdrawn tax free. But that's not how it's written. What it really acts more like is a non-deductible traditional IRA. The main difference being, if you have a child, maybe it's your son or daughter or grandchild, and you want to make a retirement contribution on their behalf, that child currently has got to have earned income in order to do that. So if it's a child that's just maybe too young to work, they can't make a contribution because there's no earned income to support it. So where this would come in is there's no earned income requirement for these. Contributions can be made according to those limits that were on the last page without any earned income. But if you put money in there, then it's going to be after tax. So when money comes out later, even if it's a qualified expense, first thing is the contributions you put in, those will not be taxed because that'll be your basis. Any earnings will come out and be taxed, as well as any of those employer contributions, because remember, those were pre-tax contributions, so they didn't show up on your income whenever they were made, but they would be income to the child when coming out. So it's in a nutshell, it really looks a lot like it's a non-deductible IRA that you don't have to have the earned income requirement for. However, with an IRA, you can keep it for the remainder of your life and let it grow as long as you want to and use it for retirement, whereas these actually mandate distribution at no later than age 31. So there's a lot in here that just kind of doesn't make a ton of sense, and I think it's going to be revisited hopefully in the near future. But if you're looking online for information about these, just a disclaimer, you're going to see things like the qualified distributions are tax free. You're going to see things like they're not tax free, but their tax is capital gain. That was not what we found when looking directly at the law as it was written, and I think a lot of that likely comes from the fact that when you see what it actually is and what it does, it's like no, there's got to be more. It can't be this. It's got to be more useful, more helpful than this. And I think that's when imaginations kind of get going. So just be careful when you're looking, and we'll keep you all updated on what we find if changes are implemented or if the IRS gives us any clarification on some of this stuff. Any questions on those before we head on? We'll give you just a moment if you'd like to just unmute and have a question about the Trump accounts or what you've seen. I'd be curious to see if anybody else has seen some differing information on how those work. If not, we'll keep moving. Mm. Into business changes. So if you happen to own a business, one of the things that's been really helpful over the last several years is the qualified business income deduction. That was something that was temporary, so it was made permanent. There were no changes to the amount of deduction, so it's still at 20%. And really, so what that is if you own a company that's a pass-through entity, like an S corp, LLC, and you operate here in the United States, they wanted to give most of those owners a deduction to reduce their income. Like it was back whenever in 2017 they reduced the tax rate of the C corp. They wanted to give the S corp owners something that kind of helped in the same way. So that was what the QBI deduction was. There is a phase in for deduction. So if your income starts to get too high, some of your deduction starts to be limited. They kind of redid the formula for that and made it a little simpler to figure out. There was a complicated way to really computed that before, so they simplified things there and then added a minimum deduction. But if this one thing to note on the QBI is they do have a segment of industries that they call special service or trade or business. So what that is if you are in the industries of healthcare, accounting, financial, which would include us, financial planners, financial advisors, and then the other category is attorneys, they actually do not let you take the QBI deduction. However, if you have income from multiple sources, you can take the deduction on income that's from a source that isn't on that list. So if you happen to be someone who operates in the area of healthcare, but you also have a retail part of your business, then the retail part still qualifies. So if you have any questions about any of that, be sure to check with your CPA. But really, the bottom line here is not a whole lot has changed, but it was made permanent for everyone. Bonus depreciation is here to stay, and what that is if your business buys an asset for an actual business purpose, bona fide business purpose, then you can take the entire deduction for the cost of that. And that's particularly useful in a year where you have a higher than usual income for some reason. If there's a high income year, you can then reinvest that into an asset to help offset that income. And that's one instance where you might want to consider expensing it all up front. However, you may want to consider doing it more evenly, just amortizing it in some cases, because in some cases you may want to take the deduction slowly over time. So just work with a CPA on that and make sure that you understand and are in communication about whether to expense or whether to kind of capitalize asset to take the deduction over time based on kind of how the flows of your business are going and what the incomes look like for that year. Same thing for 179 there section. That's the original section that allowed us to fully expense equipment that would have previously been capitalized. The limits have been raised, and they're going to index those for inflation. So it's going to help businesses be able to take more of that deduction up front for things that they purchase throughout the year. And then R&D expenditures are also immediately deductible as well. So I know that Mike and I have covered a lot. If there are any questions on anything, feel free to unmute and ask. We have about 5 minutes left, so if not, we do have a couple things we can just quickly skim over. There was a lot of material here overall, so we made a section at the end of the presentation that we can send out and will be included in the slide deck, but maybe wasn't as relevant to everyone. But if any questions at this point, please just unmute and let us know.
Thanks, Charlie. That was good info. Yeah, drinking from the fire hose is over, y'all. So we're good on that. But yeah, if you have any questions on the tax package or something else related to taxes, go ahead and just unmute your mic and jump on in, and we'll be happy to answer that while we're here. Meanwhile, we do have some bonus material for you in the slide deck that we're going to send out with the survey. A couple of key items that we'll be looking at there. Um, there's some slides related to the alternative minimum tax. So for those of you who have never heard of that, you're wondering what in the world is AMT? It is literally an alternative method for calculating your taxes. It's been around for decades, and essentially it calculates taxes, not accounting for some deductions and not accounting for some tax-free type income. So it makes adjustments to income, makes adjustments to deductions, has its own tax rate applied to it. And in true fashion with the IRS, you pay the higher of the two. So whichever
Mhm.
calculates to the higher number is your actual tax bill. AMT does not impact many taxpayers. That may be why, if you've never heard of it, because it hasn't applied in your situation. But there were definitely some changes made there. So we're going to include that in the supplemental deck that we send out to everyone. Also, there were some changes made with a college endowment tax, in the philanthropy and education section, employer education assistance as well. There's some impact on that in the bill too, with a couple of other miscellaneous tax changes we'll highlight there, and some changes to the ABLE accounts. If any of you are familiar with that as well. Last item that we'll include in the bonus deck is beginning in 2027, bringing back investments called qualified opportunity zones, which is a way to allow an investor to participate in urban redevelopment or other areas of the country and receive some tax benefits and some income for doing that. So that'll be something to follow in 2026 as it comes online in 2027. So with that, that's the highlights that we've hit. We'll open it for last questions one more time. Anybody have any questions or comments? Feel free. Open mic. All good. Thank you very much, y'all. So hearing none, we really appreciate everyone touching base with us today and attending the webinar. Of course, if you have any questions post session, feel free to message us or email us, and we're happy to answer those, especially if it's something specific to your situation. We'll have the slide deck out to everyone with the survey later today or first thing in the morning. And if we can be of service to you, please feel free to contact us. Everybody have a great afternoon. Thanks.